Imagine this: you've done everything right. You've saved diligently, invested wisely, and built a solid retirement plan. But there's one major risk that could still derail everything, and most people ignore it. It's long term care. Here's the reality: 70% of people over age 65 will need some form of long term care. If you're a high net worth retiree with between a million to 3 million in investments, you're in a tricky spot. You're too wealthy to qualify for Medicaid and likely don't want to, but also not so wealthy that a long term care event wouldn't seriously impact your portfolio. Today, I'm going to show you exactly what long term care costs, why self insuring may not be enough, and the smartest ways to plan ahead without wrecking your retirement. Hey, my name is Kevin Adelman, co founder, wealth advisor, and retirement income certified professional with Ignite Wealth Planning. Let's talk numbers. Here's what long term care actually costs today: a home health aide, around $75,000 per year; assisted living facility, about $64,000 per year; a private room in a nursing home could be over $116,000 per year. Now consider this: many people need care for 3 to 5 years. That means a couple could spend $500,000 to $1 million on care alone. Let's say you and your spouse each require 3 years of care, one after the other. That's 6 years of high cost care, potentially reaching $700,000 or more. And here's where it gets risky. If you're forced to sell investments during a market downturn to pay for care, that could permanently reduce your retirement income. If one spouse requires care, it could drain the couple's assets and leave the surviving spouse financially vulnerable. And any money spent on care is money that won't go to heirs or your charitable legacy. Long-term care isn't just a health issue, it's a major financial threat. So how do you pay for long-term care? Here are the 3 most common options. Option 1, self-insure. Many wealthy retirees assume they'll just pay for care out of pocket. But even if you have a $2 million nest egg, a $1 million long-term care event could cut your portfolio in half. Think about what that could mean: less flexibility, a reduced legacy for your kids, and added stress during what should be your most peaceful years. Self-insuring is possible, but oftentimes only really makes sense if you have $5 million or more in liquid assets. Either way, you need to set aside a sum of money that will no longer be able to be used for income during your go-go years of retirement. Of course, if you already have major health concerns, self-insuring may be your only option. If so, it's important to create a game plan around which assets and how much are going to be earmarked for potential long-term care costs. Option 2, traditional long-term care insurance. This type of policy helps cover care costs and protects your assets. Imagine paying $4,000 a year for coverage that could provide $300,000 in benefits if you needed extended care. That's powerful leverage, but only if you buy early and stay healthy enough to qualify. Traditional long-term care insurance is designed to reimburse you for the actual cost of care, whether at home, in an assisted living facility, or in a nursing home. It's one of the most direct ways to shift long-term care risk to an insurance company. Typically, your policy kicks in if you're unable to perform 2 out of the 6 activities of daily living. Here are the key components to understand. Daily or monthly benefit amount. You choose a set benefit amount, say $150 to $300 per day, that the policy will reimburse you for qualified care expenses. This determines how much coverage you actually have on a monthly or annual basis. 2, the benefit period or benefit pool. You can select how long you'd like the policy to pay for care, typically between 2 and 6 years. Some policies offer a benefit pool, which is a total dollar amount you can draw from, giving flexibility to use more or less each month depending on your care needs. 3, the elimination or waiting period. This is like a deductible, but in time. It's the number of days you must pay for care out of pocket before your benefits begin. Most common is 90 days, but options include 30, 60, or even 180 days. Shorter elimination periods mean higher premiums. 4, inflation protection riders. One of the most important add-ons. With care costs rising annually, policies often offer 3 or 5% compound inflation protection. This increases your benefit amount over time to help it keep up with rising care costs. Without this, a policy bought at age 55 may not cover enough when you're 85. 5, shared care riders. For couples, this allows both spouses to share each other's benefit pool. If one person uses less, the other can tap into the remaining benefits. It adds flexibility and peace of mind for joint planning. 6. Return of premium or non-forfeiture options. These riders provide a partial refund of premiums or a minimal benefit if you cancel the policy or pass away without using it. It adds cost but gives back at least some value if care isn't needed. But there are caveats with traditional long-term care insurance. Premiums can increase over time, even after the policy is issued. And if you never use the coverage, most, if not all of that money is gone. Still, for the right person in their 50s or early 60s, especially those in good health, this can be a very effective hedge against catastrophic long-term care costs. It's also one of the few tools that can help you protect your spouse or legacy from a major financial drain. Option 3, hybrid long-term care insurance. Hybrid policies combine long-term care coverage with life insurance or an annuity. These have grown in popularity because they solve one of the biggest objections to traditional long-term care insurance. What if I never need it? Here's how they work and what to look for. So 1, you have a life insurance with a long-term care rider. These are permanent life insurance policies, usually whole or universal life, with a long-term care rider. If you need care, you can access the death benefit early, tax-free, to pay for qualified long-term care services. If you don't use it for care, your beneficiaries receive the full or reduced death benefit. Annuity-based hybrids. These use a deferred annuity as the base product with a long-term care benefit multiplier. For example, $100,000 in annuity might provide $300,000 in long-term care benefits over a 6-year period. These are attractive for people who want to reposition low-yielding assets for care purposes. There are also certain income-producing annuities that may increase your monthly income, say double, for a period of time if you have a long-term care qualifying event. You can typically pay a single premium up front or choose limited pay options like 10-pay or 20-pay structures. This makes budgeting easier and avoids lifetime premium risk. Some policies also offer return of premium options if you change your mind. You usually choose a monthly benefit amount and a duration, say $5,000 a month for 6 years. Benefits are either indemnity, a flat monthly payout, or reimbursement. You submit bills for covered services. Indemnity benefits are simpler and more flexible, but usually offer less maximum leverage. You can also get inflation protection on these policies. Some offer 3 or 5% compounding inflation to ensure the benefit keeps pace with rising care costs. A critical feature if you're buying coverage in your 50s or 60s. And benefits used for long-term care are generally income tax-free under IRS rules. Also, premiums paid via 1035 exchange from an existing life insurance or annuity contract may avoid tax consequences. Let's talk about a bonus strategy, using a home equity conversion mortgage or reverse mortgage as a long-term care safety net. If you're 62 or older and own your home, a specific type of reverse mortgage called a home equity conversion mortgage can be a powerful tool. Here's how it helps with long-term care. You can open a growing line of credit that increases over time. You can draw tax-free cash to pay for in-home care or assisted living. You can even use it to pay your long-term care insurance premiums. For example, a 66-year-old homeowner with a $400,000 home might set up a HECM line of credit worth over $190,000. That line of credit grows each year, possibly reaching $300,000 or more by their 80s, just when long-term care may be needed. Wade Pfau and other top retirement researchers have shown that using a HECM proactively can make your overall retirement plan more resilient. For many high net worth homeowners, this is a great way to turn home equity into a long-term care buffer without needing to sell the house or liquidate investments during a downturn. So what should you do next? Here are 3 smart steps to take. Get a long-term care plan in place. That could be insurance, a home equity conversion mortgage, line of credit, self-funding with dedicated cash reserves, or some combination of all of these. You want to stress test your retirement income against potential care scenarios. What happens if one of you needs care for 5 years, or both? Try to think of as many different situations that you may encounter in order to be prepared for anything. And talk to a financial advisor who understands tax-efficient ways to fund long-term care and can help you align that plan with your broader goals. Remember, this isn't just about protecting your money, it's about protecting your freedom, your spouse, and your legacy. Long-term care is one of the most overlooked risks in retirement. If you don't have a plan, your retirement is vulnerable. If you want a custom analysis of your long-term care risk and the smartest funding strategy for your situation, feel free to click the link below and schedule a call with our team today. Make your retirement plan complete. Thanks for watching, and don't forget to subscribe for more strategies on making your money last and leaving a meaningful legacy.